I'm Reed Robinson, the founding partner of Groove Capital. With me is Emmet and Ava. You want to say hello?
Sure, yeah. I'm Emmet. I've been working with Groove for about 1.5 years now, mostly on the investments and due diligence side of things. So yeah, started right before we made our first investments, and since I've had the chance to look at a couple hundred deals, and I'm excited to share what I've learned.
Yeah, and I'm Ava. I started at Groove this past March, so have been here a little while now. Analyst on the Groove team, and in addition to my roles at Groove, I'm the VP of Platform at Atlan Ventures, which is a student-run venture club made up of students from the University of Minnesota.
Okay, real quick on who is Groove. Kelvin mentioned 40-plus investments since January of 2021. So every month we're looking at, let's call it 30 to 40 deals. This is the team that is reviewing them. So what we're trying to do in the following conversation is like what happens behind the scenes as we're reviewing the emails that you send us, the pitch decks that you send us, the pitches that we have together, the diligence, et cetera. But we're the most active pre-seed investor in Minnesota. That's the area that we like to target. We want to be the first institutional investor, and we've been doing that kind of time and again. So super fun, love this community, and glad to be a part of it in this fashion now. Before we jump through the kind of process and each individual part of this, I want to caveat our conversation by saying two things. The first is, we're one of countless places that you can go to get an investment. We believe what we're sharing, and we're going to try to be as honest and forthright as possible to help you hone your pitch and increase your success rate in raising money. But just know that this is our opinion, and others may differ. And then the second point is, if this comes off by any means negative or too harsh or anything, I don't think it will, but if it does, I want to remind everybody that the job of the investor is to invest. We want to say yes. And so when we're seeing your materials, when we're seeing your pitches, we're looking for opportunities to make investments. That's our job. So we want you to go into those with that in your head, thinking, okay, they want to invest. Now it's my job to convince them that we're the right people for them to invest in. So the way that we're going to organize the conversation today is kind of through the process. So, every path is going to be a little bit variable, but generally speaking, you're going to figure out your game plan. There's going to be some sort of introduction where we first get introduced, generally via email, sometimes in person. There's a formal pitch, then the diligence process, and if you're successful in all those things, you get the money. So each one of us is going to kind of actually talk about the area that we largely represent in that process. But before we get into any of that, it's important to know that if you're going to talk to institutional investors, there are some expectations. We're not going to go through all of them in this slide. So if you want, take a quick picture of this, because these are the things that you should probably have prepared before you even approach this in the first place. 3, 2, 1. Okay. All right. Well, now let's. if you need it, you can. Our emails are at the end, and I'll send it to you. But let's jump into the process. So the first part is the preparation work that goes into setting yourself up for success in raising money. The first bullet on this one about self-reflection is something that I think is so often overlooked by the founders. And it's not something that you might expect to see as kind of coaching in this, but I really believe the people who have the most success in fundraising have done some very critical self-work. What I mean by that is they think about their strengths, they think about their weaknesses, they try to understand their motivations, They have a good understanding of who they are, and this is all super important because you're about to embark on probably the most like exposing experience that you'll ever have. You're gonna have people like challenging you the things that you care about, the things that you're convicted by, and if you're not like rock solid on who you are, you're gonna get pulled in a lot of different directions. So like mentally, get yourself sound, and then the rest of these bullets are basically now switch gears into like the most epic sales job you've ever had. So how do you be successful in sales? Well, you have goals, you have deadlines, you know, so if you're raising money, you don't wanna linger and let that last forever. You know, set up a goal. How many people do I need to target? Research your options, understand who your customer is. In this case, that's the investor. What do we know about them? Well, let's look at their website. Let's look at some of the other companies that they've invested in. Let's try to understand the themes that they're most attracted to. Building your list, finding connection points that can be good introductions. I think Beta and other entrepreneurial support organizations can be excellent ways to lean into those organizations to make introductions. But that's not necessary. I think most venture groups, including us, are happy to get a cold outreach. That's fine. And then practice and kind of dial in your assets. On the like what to avoid or where things usually go wrong, like the ignoring the website, the portfolio, and skipping office hours, just don't do that. It immediately sends the wrong signal that, you know, hey, I'm this Series A company. I want to talk to you, Reed, and Ava, and Emmet that write pre-seed checks. Like, did you not look at the website? It's right there. And then the first bullet here, pursuing the wrong targets. We might spend a little bit more time talking on this, but if you do your homework right, you're not going to be wasting your time talking to people who are going to say no. You know, you want to score the people that are right in the wheelhouse for the stage that you're at, the industry that you're coming from, the progress that you've made so far, and then focus your energies on the ones that are most likely to say yes. By the way, we're going to hopefully have some time for questions at the end, so if there's anything that you want us to dig in on, write it down and we'll come back to it.
Great, yeah. So now you've kind of prepped a fundraise and you're reaching out to an investor to potentially look at investing in your company. So what to do on that end? When you're first reaching out, make sure you're really clear on why. So that can be for a variety of reasons. It can be for capital, it can be for connections, it can be to just kind of maybe learn more about that fund. And the more upfront you are about why you're reaching out, the easier it'll be for us to direct you in the correct way and get that done faster. So additionally, kind of like Reed was saying in the previous slide, make sure who you're reaching out to is people that are meaningful to you and your company. So that can be close family or friends, or even investors that you fit their thesis and portfolio. Ultimately, that's going to be the most likely path to get an investment. So once you've nailed down your intent and you know who you're reaching out to, it's time to actually make that connection. When you're reaching out first, it's really helpful to provide an executive summary or pitch deck. I can say for when I look at applications, for example, I know it's probably similar with Reed and Emmet. I'm breezing through it, kind of getting a main idea, understanding what your company is, so we can have a good idea on whether or not that would be an appropriate pitch. But if you provide an executive summary or pitch deck for us, it's easier for me to visualize that faster and kind of determine whether or not this would be something of interest, and it's usually easier to get me there. As for saying enough to pique interest, I think enough is the key word here. So don't say too little to the point that now I'm confused on what the idea is. You're being too brief, I'm not quite sure if it's a fit. And then don't say too much that you're bringing up unnecessary concerns early. So make sure that you're in that range, that you have practiced that elevator pitch, right? You have it nailed down to a specific time range, specific point to get me interested enough, because right now your goal is to get the pitch. Finally, create excitement. Obviously, if you are founding a company, you are extremely passionate and excited about that, and it's easy to make me feel that way too. And once you do, I'll be much more excited to push you on to that next phase, and that excitement stays within the pitch as well. So those are some really great things to do. As for some things to avoid, if we've made a connection and you've reached out to us, make sure you're being timely about reaching out. Don't wait too long. We'd obviously like to get in deals that feel mutual and like we're equal partners, so reaching out fast can make that helpful. Yeah. You're gonna add something?
Anything else?
Yeah, super quick. So as for overlooking people, you want to make sure that you're choosing the path of least resistance, like Reed mentioned earlier. And then obviously for misrepresenting the facts, you're going to want to make sure that you are not accurately presenting your data. So that can be for, okay, these are customers that we're potentially having, so make sure that those are actual customers. You're not just trying to sell us on this is a possible group, and these are some investors that are thinking about joining. Make sure that those are solid as well. Setting up realistic expectations for yourself. So we oftentimes have founders overpromise and underdeliver. It's really important to make sure that you are setting yourself up for realistic deadlines. We're not asking you to go above and beyond. Actually meeting those deadlines is really important. So that sends us signals. Make sure that they're positive early on.
I forgot to mention this in the previous part, but when you're preparing for reaching out to an investor, the goal is to get a response. The goal at this stage is actually to get a pitch. Right? So that's why I think your comment on saying enough to pique the interest without raising a bunch of objections by saying too much is really important, because your goal in this stage is to get to the pitch where you can actually elaborate on whatever you've kind of set up for us from an expectation perspective. So let's talk about the pitch. There are a few just do these things. Practice is important. Use a pitch deck. You'd be surprised, there are a lot of people that just want to have a conversation, and that's okay in certain circumstances, but pitch decks are really helpful to guide a structured conversation. I think it helps both us consume the information and kind of prepare our thoughts for questions, while also making sure that you hit the points that you're really trying to make sure that we remember. In our case, we do a 40-minute pitch. It's usually virtual. In that 40 minutes, plan for 10 of your own content, because you want to be driving conversation and questions throughout the remainder of the time. I think as far as there's a lot of different places that you can go and a lot of different tools that you can use, including Brevity, on how to design a compelling pitch and pitch deck. But I think the most important parts that we end up talking about and thinking about are why you, how, why now, and then why bother. So we're gonna spend a little bit more time discussing those points, but remember those as you're thinking about what you really want to make sure that you cover. I think it's a cool and differentiating practice to write down notes from the conversation. So if there's something that comes up and maybe you didn't have a great answer, or you didn't have exactly the information that you needed, you can come back with a follow-up email after the pitch, just to relay you were paying attention. I think that shows really well that you're considered and that you are actively involved in the conversation. Try to avoid reading slides. It's very consistent for people to not. We're going to talk about what we find the most important, as we're considering these investments. But here's a hint: it's not the product. So don't spend a majority of your time in the pitch talking about the product. The product is important. That's the how. But it's the other pieces that are more important. Yeah, and then I think instant red flags or turnoffs are defensiveness or indirect responses to very direct questions. So it's totally fine to say I don't know, or let me think about that and I'll get back to you. But if it's a direct question, we're going to dig into it if it's not answered in the call, if we even get to the place where we're talking diligence. So with that, congratulations, you've made it to Diligence.
Yeah, so if we've decided to start the diligence process, it's because you did a good job in your pitch. We've gotten excited about, different elements of this, and we're, starting this process with the intent to invest. We've decided that it's a close enough fit, and we want to dig in more. And so the purpose of this is to, dig into those areas that we probably didn't get to cover everything in the pitch. It's to learn more about the team. It's to validate the things that made us really excited about that, whether it be specific product, just size of the market opportunity, team's expertise, those sort of things. And then it's to look for also reasons that would deter us from investing, or things that are disqualifiers. And this is also an opportunity for you to kind of show your communication and organization throughout that process, because throughout diligence we're always looking for signals on the team, and at the end of the day that's the most important thing. So we learn a lot from the emails you send, how you organize your documents, how thorough and how well thought through the plan is, and all of those things. It's good to keep in mind.
Let's be super specific on this point, because I think there's signals that are constantly coming up that you might not be aware of. And Ava mentioned one, Emmet just mentioned it. And basically it's like, when you tell us when you're going to do something and then you don't do it by that time, you've then set us on a path of, okay, well, maybe they're not great at planning. Maybe they're not great at setting and achieving expectations. So it's these little tiny micro communication points that you might not be understanding that you're sending that can start kind of chipping away at our warm, fuzzy thoughts about who you are and what you're doing.
Yeah, and on that, it may seem kind of counterintuitive, but it's much better for you to say, okay, I'll get to this when I'm finished with a project, but I'm not sure yet, and then deliver something in 2 weeks, versus saying, okay, I'll have everything for you by tomorrow and have it to us 4 days later. It's that managing of expectations is a key quality we're looking for in founding teams, and we're keeping an eye on that from start to finish throughout that process. And what this usually looks like, and different venture firms are going to have different ways they go about this, but we start with collecting legal, financial documents, more information about the team, the business plan, and the product. And then we're going to spend some more time doing our own market research, competitive analysis, kind of take a look at the size of that opportunity, see if it matches up, discuss what we think about the team's fit to the market and to the problem that they're solving. And then making sure we understand the customer. If there are reference checks, that's great. We like to look at that and really understand where this product fits into the market. And another good thing to include in that would be, if you're able to show a history of progress, we love to see that. I think my favorite thing to find in a diligence folder is a history of investor updates that go back to the very earliest stages of your company. And that way I can see that you have good, strong communication skills. The more honest you are about what's going well, what's going bad, very important information for us. And it also just shows that transparency, shows the progress and consistency that we like to see. And a few things to avoid would be not bringing things up early that are a really big deal. Part of that diligence process, like I said, is finding disqualifiers. And so if we get through the whole pitch, we're excited, and then we discover you've taken on a ton of venture debt, or you're on the edge of insolvency, or there's weird litigation or team issues, and we've gotten all the way to that point, and we had to discover it for ourselves. That's really, really hard to get past some of those things, or not providing enough information. The way we usually start our process is providing a checklist of things we'd like to see, but depending on stage, industry, and all these things, more or less of that could be applicable. But having as much of that as possible and being able to provide us with as much complete information is really important. And then, kind of touching on the financial model piece, we know that projections aren't a guarantee of anything, but what we're mostly looking for is an evaluation of, does this model work? Are you thinking this through? Is there, a decent degree of financial literacy, and yeah, just kind of understanding how the founder is thinking about the future of the business. And yeah, another thing to get out of the way early would be alignment on terms. That kind of goes back to chasing the right investors and making sure you're going after ones and spending the time with investors that are likely to invest. Because if you get through all the diligence process and you end up at a way different valuation or raise size or something like that, that kills the whole process, that could have been avoided early and save everyone a lot of time. But yeah, and then usually at the end of this process, it's kind of on us to take in all this information, do our own research, and get back to you with a decision. And some exercises we like to do at the end is when we have a scorecard where we have different categories of product, market, opportunity, team, thesis fit, and the deal. And then we kind of rate those different categories 1 through 5 and see what the cumulative score is, and we've attached different weightings to those categories. And I guess the main takeaway is by far the heaviest weighted categories are team and market opportunity. And so that's ultimately what's most important to our decision at the end of the day. And yeah, Reed is going to talk a little more about what we're really looking for in the team.
Cool. Yeah, and so you hear this a lot. I mean, I don't think we're unique in comparison to other venture groups that really like great teams and really like great markets. But I don't know if explaining well, what do they actually mean by teams is effectively done. So we want to spend some time talking about that. And so we've got 3 columns here: the experience of the team, the composition of the team, and then the dynamics of the team. On the experience side of things, as a result of my work with Beta, my own kind of personal experience within startups, I've learned a lot about what makes teams successful. Industry experience is, in my perspective, more important than startup experience. So if you come in without startup experience, it's your first time, that's okay. Then surround yourself with some really great, smart people that can help you learn the challenges of running, a growth entity. But the industry experience is really important because that helps us understand that you kind of know the soft spots where the competition's weak, where the market opportunity is. We'll talk more about that. But on the business model perspective, I've also seen really successful founders be, pretty unsuccessful in areas where their business model is totally different. So it doesn't always apply that, hey, I've been successful in one startup over here. If I go apply myself over here, we're gonna get the same results. That's not the way that it works. So knowing how these businesses work is really important. We talk probably more than anything about the business or the builder and seller profiles. And this has other names and other models like the visionary or the integrator and the traction model, or Steve Jobs and Wozniak at Apple. These are common profiles, but they're true. And what you need at the very beginning of a company is somebody that can get a whole bunch of people excited about something. That's the visionary. And then you have to have somebody that can actually deliver on the expectations set by the visionary. And that's the builder. So those profiles could be CEO, CTO, engineering, blah, blah, blah. It doesn't matter really what the titles are. It's more like what functions do they serve. And so you might be thinking is it possible that this is the same person? I would say that's probably 1 in 10,000. They exist, but they're incredibly rare. So that's part of why, some self-reflection at the beginning of the process. Where do I fit? It helps us understand these things. And here's a trick, if you find yourself in the fundraising process and you hate raising money, you're probably not the seller. You're probably the builder. So find somebody that loves that and somebody that's equally passionate about it and can be super motivated to do those activities. Every team has gaps, and I was going to say this in the diligence piece, like no team is perfect. We know that. And we don't expect that. But we do expect that you've thought about it. You know, you've anticipated the questions that are going to come up and say, like, hey, looking across this team, I'm not seeing any sort of marketing experience. Like, how do you plan to fill that? Like, your go-to-market plan sucks. What are you going to do about it? And acknowledge that, anticipate it, and then fill it with the resources that you can when you can. And then on the dynamics piece, like we pay attention to the way that they interact with each other in the pitch. You know, are you talking over yourselves? Is there actually like joyful interactions between them, or does this feel kind of weird? And why are they doing this in the first place? Like, I will say more often than not, the reason that we say no to a team is it's pretty obvious the reason that they got into this business is they thought startups were cool, not because that they were the right people to be successful with this business. And so that's kind of keep coming back to this whole self-reflection piece. Why did you get into this in the first place? It's really, really important.
Yeah, and then competitive advantage is, a really important piece of, when we're evaluating startups, and, at the earlier stage that can look very different depending on what the startup is. I guess mostly, hitting on what we think is actually important. A lot of it comes back to the team, but, quality of the team, having insider information, kind of going back into that industry experience. If we're looking at a founder who's been staring a problem in the face for 10 or 15 years and, got so sick of it that they needed to go out on their own and solve it themselves, and they, know all those specific pain points really, really well, that's something we like to see. And then, another thing we talk about a lot in the diligence process is the different relationships that founders have within that industry or, within what they're trying to build that can get them ahead. What are executives at big, related firms, or what are big customers that they have an intro to that can help them win over the others? Because if you're going after a compelling market opportunity, which we love to see, you're probably not the only one doing it. And so we need to look for all the signals that are, why can you be the person and the team that can win in this? And then, persistence and follow through, kind of like we talked about, those signals that we're looking at and looking for throughout the whole process. Those are an advantage, but that's something we kind of pick up ourselves and try to make sure we have a good sense of what this team can accomplish. Then what not to do, it's a little different than that, but just saying like, we'll out hustle anyone, or we want this more and we're more hungry is not that compelling. Show us that. Don't just tell us that you're cooler than everyone else. And then, product features, usability, and price kind of fall into the bucket of this is really early stage. Things can be, mimicked. A lot of things can change. Prices can change. Competitors can match these things. And we know a lot of that is subject to be very different by the end of this. And so having advantages that are, just slightly better features this early stage is not quite as important to us as those team qualities and relationships and experience in the industry. And then there are a few things that kind of fall into the middle category. Speed, first mover, more capital can be a good or bad thing. And for all of those first three, you want to make sure that you're on a sustainable path and not way ahead of yourself. Raising a bunch of money, hiring a ton of headcount, and then not able to deliver on those promises. But also having the resources of that in any of those categories can definitely help you get ahead. And then IP be really dependent on, I guess, what kind of company we're looking at. But yeah, if it's important and that provides a really strong moat and defensibility, it's something we're going to look into. Oftentimes it's not, and that's not a super compelling reason by itself to believe in this team and their ability to go after it. But a lot of this is, like I said, really dependent on the market and startup, and Ava's going to talk a little bit more about that.
Great, yeah. So now we know that you have this amazing team and this great competitive advantage, but beyond that, it's really important that you have a market because obviously those are the people who are going to actually use this. So how do you kind of determine the market? So when going about finding your market size, all right. Oh, no, we're all good. Yeah, when going about determining your market size, so within that market, there's usually going to be a total addressable group that the industry you're in will fit. Within that total addressable group, there's only going to be a percentage of them that are actually serviceable. So once you determine that serviceable group, only a certain amount of those individuals will be obtainable, which will be the market size for your business. So how can you kind of find that obtainable market is looking at external factors as well, such as the competitive landscape. So who else is in this field? How much of the space are they taking out? And how much does that leave for you? So once you've determined what your market size is, it's now time to figure out how you're going to capture it. So that goes along with your business strategy, your business model. So is this a good fit for the consumer? Are they going to be willing to pay for it? And is it going to get you enough money to sustain your business and get you good returns? Your go-to-market plan. So you have this group, but how are you going to reach them? Is that going to be through social media, through partnerships, through paid ads? Be really specific about that so we can actually figure out, okay, well, they know about it, but now why do they want to use it? How are you going to get a hold of them? And then with a competitive advantage, similar to what Emmet was talking about in the previous slide, ultimately, you're going to want to get that group that you reach out to get on board your platform. So why are they going to, and more importantly, how are you going to sustain that group, I would argue is really important. So now you kind of have the market size, you have a plan of how you're going to capture them, and now it's our time to determine whether or not it would be worth it. So is the right? Is it too early? Is it too late? Is it just not the right time for the market that you're targeting for external reasons? Your funding strategy, are you asking for too much that it's going to be hard to meet those expectations for investors in the future, or too little that it's going to be hard to continue that runway and run your business long term? And for the exit plan, ultimately, because we're investing in startups at such an early stage, we want to see a really adequate return. So what's your plan for exit? How long is it going to be? How much for? And what's that going to look like long term? And then once we have a good idea of that team, of the competitive advantage and the market, we'll be able to move forward with an investment decision.
So this is the why bother piece of the pitch. And just a couple quick additions. The TAM, SAM, SOM piece, we know that math is wrong, but your goal is to explain it. Why do you think this is a compelling opportunity? And maybe not have all of the explanations on the slide, but be prepared maybe in an appendix that you can kind of reinforce. This is a super big untapped or tapped market that you can exploit. And then back to my pitch slide, the things that we often see overlooked in those pitches are how are you going to capture it? It's the business model and the go-to-market plan. How does this business actually function? How do you make money? How does this turn into a large organization? And the actual mechanical movements of growing the business, which are related to your go-to-market. So yeah, I thought it was worthwhile to double tap on those things. All right, well, we've covered a lot very quickly, and I'm hoping that as a result of the Q&A, we can actually share some examples without using names, and kind of get to the bottom of whatever questions are on your mind. But just as a quick reminder, as we started, we want to invest. We want you to go into these conversations thinking positively, showing your enthusiasm for your team and the mission and kind of task at hand. We've talked a lot about the importance of knowing yourself. We've alluded to kind of this planning and this working backwards, but just to double click on that, I love it when the person knows exactly what they want to accomplish, and then they work backwards to figure out, okay, if I want to be bought by so-and-so for X $100 million or $1 billion, I'm going to need to get to this. In order to get to that, I need to get to this, and then I need to get to this. And so we're right here, and they've laid it out and worked backwards. I think that's we know that the path will change, but the fact that you actually thought about the things that you need to accomplish in order to reach the ultimate goal, I think is really smart and differentiating. A lot of time gets wasted pursuing investors that are going to say no, so your homework up front will save you a lot of time. The things that I consistently say, if somebody asks me like, okay, you guys are Groove, what do you want to see at the pre-seed stage? And my two adjectives are substance and momentum, right? So substance is like, is this thing real? How much have you kind of breathed life into it? What assumptions have you validated so that we know that there's some bones to this? It might not be a grown-up entity, nor should it be where we're investing, but there's something there. And then the momentum, Emmet gave a very good example of having that, those investor or advisor updates that you've shown over time. Those and many other things are the best way to say, okay, whatever traction is, it could be sales, it can be product development, it can be, your ability to kind of fill gaps in your team, whatever you choose as like, this is the thing that we know that we're kind of building and the pace in which we're solving these things, that pace matters a lot. And then, the last thing, if there's one thing that you can do that's going to help you win, I think it's just do what you say you're going to do or more. It's the hardest thing to do, it turns out. But if you're really good at setting and managing expectations, you'll be able to stand out. So with that, thank you both for sharing some of your thoughts. Let's maybe switch gears to the Q&A, and we'll try to engage the virtual audience as well. But who wants to be first to ask a question?
Hi, Reed. Just question for you. What is Groove's capital initial check size for investment?
So from Fund 1, we write a $100,000 check as kind of the de facto. That's the way our model works. We invest in, as you can tell, a lot of companies. And then we have that secondary pool of capital, which is our LPs and angels. So once this group and we've come to an agreement on the terms, we actually take that, we share it with our LPs and angels, and they have the opportunity to add more. So it kind of depends, but generally speaking, when we're walking into a decision mode, we're starting at $100,000.
And follow up, what was the last company that you invested in, and what do they do?
I guess technically it'd be Nordic Waffles. So this was one of our food businesses. I think it was our third or fourth. If you were at the state fair, they had a stand, and that stand was very crowded, I am happy to report. We've done a few food deals, like great opportunity, totally crushing it on the sales side of things. Amazing product, good story, like it has all of the elements of what you'd look for in an early stage food deal, and the terms were great. So I think that was probably our last investment.
On one of your slides, you talked about misalignment of terms. And what are the biggest faux pas that founders do in terms of misaligning with you on terms? Or what are the things that are undergirding specifically on the misalignment of terms or you see as the biggest?
I'll start, and Emmett, maybe you can jump in since you're usually looking at that with me at the end. Being maybe like too fixated on where you should be at. Here's a common mistake. I'm a founder. I've never done this before. I want to try to get something that is favorable. I'm going to Google search, pre-seed terms for startups, and I see a blog written by somebody in the Bay Area. I got news for you. That's a different market. So your expectations are completely out of whack. And the way that I talk about it often is it's just like real estate. look at your comps. Like if you've ever bought a house before, the way that they're figuring out the right price for a house is like, what is the one that was right next to it sold for? How many bedrooms does it have? How many bathrooms does it have? What's the kitchen like? You are doing, and we're doing that when we're coming up with the terms. And it's market-based. It's industry-based. It's market opportunity-based. Like all of this stuff is getting included in it, but it's that's one issue that comes up often. The other issue is it's that misalignment of like, I'm gonna raise, we're pre-product, we're pre-revenue, I'm gonna raise $2 million for the SaaS business on a $10 million cap or whatever it happens to be, and it's like, no, you're not. Like nobody, even repeat founders, depending on who you're talking to, like you really, really have to be outside of the like standard, mean to do something like that. And we're not trying to be aggressive. We're trying to be fair. Like we want to make sure that when we're approaching that conversation, that we explain our work. Like, well, here are 3 other deals that we did recently that are kind of similar and how we got to this number, so that we help you understand kind of what, where we're coming from. And I would be prepared to do that yourself as a founder if you're getting information from other places as well. You don't have anything to add?
Yeah, I suppose just as far as like actual terms, valuation and raise size would be where the biggest misalignment would be. And another consideration of that too is like, okay, maybe we're excited enough to kind of invest at terms that aren't super favorable, but we also have to consider the fundraising risk of, can you fill out the rest of that round? And are these terms fair enough to other investors where they're going to want to get involved too? If we're writing a $100,000 check into $1 million round, there's a lot left to cover, and we want to be confident that you're able to do that.
Good question.
Hey, Mike Ellsburn with Hinckley Medical. My question is, it's easy to get excited about investment opportunities, and often, you may not have a ton of opportunities, but what can help qualify the investor for your team and your company, looking at it from a founder perspective?
What do you guys think? Well, the question is, what should you be looking for as signals as far as whether or not they're going to be interested in investing in us, right?
More so past that point, okay, they are interested, but, more so, okay, the investors are interested, but this is a partnership. You're bringing in outside money. They have a say now. You're not just, the LLC that you were before. How do you qualify those investors to be the right fit for your company to bring in?
Here's a trick. I really like that question when it comes up in office hours. So if you take advantage of the tools available to you, assuming, I think pretty much every venture group in town, for the most part, offers that, and other places. But I would ask, like, I love the question, okay, you guys write a check, and then what? Like, what is this partnership like? I think that when you take advantage of those resources and you ask questions that you think might be stupid or maybe too rudimentary I don't think that when we're in those conversations. I actually appreciate that you're trying to understand the relationship, because that's what it is. It's a marriage for, hopefully 10 or less years, 10 or fewer years, and that's what we're signing up for.
Am I on? Oh, sweet. So you brought up earlier around this concept of why now, why bother? Just with a concrete, specific example, would you guys be willing to share how people have answered that since 2021 that really stood out to you?
So let's try both. Why? You want those two, Calvin? Yeah. Why now and why bother? Who wants to start?
It's all you.
Oh, come on. God. All right. Why we're doing why you and why bother? Why now? Why bother? I mean, why now? It's one of those interesting things that is almost out of your control. So why now is a market movement, and some people are very successful in creating brand new markets, and that's amazing. That's not usually the case in for a lot of investments, but and so for the ones that are not creating markets, the other one have to anticipate which way is the market moving. So why now? I can think of an investment that we said no to that was a consumer product that was, and I'm trying to use discretion here, was not right in the wheelhouse of where all consumers were for how they wanted to protect themselves and their respiratory health. But then COVID happened, and then the market just went from over here to like right smack in the middle of where they were, and they just landed perfectly in it. And then so okay, let's take advantage of this. We're now dead square in the middle of what consumers want to do right now, given the circumstances. And so we had to ask ourselves, from a why now perspective, can we capture as much as we possibly can during this period of time, and do we anticipate that this might shift back, where this thing might not necessarily be as a great of investment in the long term, because we have to think at the scale of decades. So in this case, I think our answer was, this is going to shift back, and I don't know if they're going to be there long enough to be successful in it. So that's why now, why bother? The why bother is a combination of how big is this opportunity, your likelihood of capturing it, and the competitive space, et cetera. Like, I would say the hardest no's that we have are the ones that like check, great team, great product, great people across the board, good solid deal, and then we get to the market and it's like, this just isn't big enough. We are a venture group. The way that venture groups work and the way that venture math works, we cannot just consistently hit singles. And so we try to make it clear to the teams that we're working with, like, we love this business. Like, you are going to be a successful business owner, but that does not necessarily make you the right fit for venture and the venture model. So that's the why bother, is we have to be looking for returns that can dramatically impact our ability to give our investors their money back, plus a whole bunch of friends.
Going off of that, quick follow-up. So I know some funds say like you should be able to return like 25% of the total fund amount. Like, what is it for you guys?
I think, candidly, I would say I'm still learning the answer to that question. I don't know if you guys feel the same way, but there's a lot of debate on the subject. There are some people and some funds that construct a portfolio, let's call it in like risk mitigation mode, where they just stack singles and maybe that's their strategy. And then there are other people that just purely chase moonshots. My current opinion on the subject, and I am increasingly more convicted on this, is kind of the Moneyball strategy. Like, I want base runners, and sorry to use a baseball term, but I want base runners and I want runs. Like, we want to balance the portfolio of both mitigating risk and chasing some really exciting big opportunities, because the collection of those is a combination of people that can produce dramatic returns while simultaneously getting rid of the ones that we're trying to cover. So that's kind of the current thinking.
Hi, my name is Abu Naeem. I'm a co-founder of Prelease. We are a public benefit corporation. So one of the questions I want to ask is, for investors, are they more focused on the exit plan or of a long-term sustaining business?
It's the former. How do we get money back is the most important thing, right? So if we ask you, okay, well, what do you want to accomplish with this thing? And the answer's unclear, or your desire is to sustain this business in perpetuity, how do we get our money back? And generally speaking, it's not in distributions, it's on an exit, it's some IPO or acquisition. And we can't be signing ourselves up for something that doesn't have an end, because our fund life and the way that these models work is we actually stop at some point and say, okay, we're done. And then that's what determines the investor's ultimate return. So we have to have an end in order to accomplish that. Does that make sense?
Yeah, so just to clarify, so the idea is that acquisition is the desired end result. Like, when you invest in something, you have to communicate that, there are Google, Amazon, or whatever, that's the goal of being bought by them. And, I did research on, like, when you get acquired, they acquire the team as well. So, like, there's, it's not just, but yeah, so I just wanted to clarify that, because it's a different type of motivation, and I guess is there different types of investors that for versus long term versus short term, I guess.
For sure, and that's a good question, and important to comment that there's actually a broad array of places that you can get access to money from traditional to untraditional. So we are talking about venture right now, and to your earlier comment, like, is your goal acquisition? Not necessarily. Our goal is a big return in a reasonable amount of time. How that happens, TBD. But those are the outcomes that we want.
We're gonna go to an online question now.
Yes, we have 3 online questions. The first is, once you reach the diligence stage, how many companies move forward to the next stage?
Emmet.
So it's once you reach diligence, how many move forward to an investment? I would say this probably varies quite a bit from firm to firm and different stages, but in our case, it's around a third make it from diligence to an investment.
Thank you. The second, would there be an investor/mentor who could help me refine my product, story, and plan so that the investor would be interested in investing with me, or in the very least, tell me what I need to work on? I've worked with Minneapolis mentors to develop a pitch plan in 5-year financials, but the investors I've spoken to have told me to come back to them when I have a 5 million ARR and I need the investment to get started. By the way, I have a product that is generating revenue now. I need investment to grow it, not to build it.
Take advantage of office hours, because that's where we can have these types of conversations. So that's how you can engage with us. To give you some useful feedback to help you figure out what to do now. But then I would say, like, if the answer is no, that you're hearing from the different people that you're talking, I think it's fair to respond with, would you be willing to help me figure out what I need to get to in order for you to say yes? I think that's a sophisticated question for a founder to ask. And I think a good venture capitalist should be able to articulate what is it that they need to reach. We try. We don't always succeed in that, but I think we try to be pretty straightforward on that.
Awesome. There is one more on here. What is the percentage of equity you generally take for that 100K, or what is the initial proposal if you set terms?
It's not in the calculation. So that's probably more common at a later investment stage with larger investments. So we aren't targeting a specific equity position. We're targeting a good deal in a fair terms, and a company that has the ability to graduate to the next stage.
Thank you.
All right, and I'm sorry that I know we have a lot of questions out here, but we are out of time. at this point. We have to move on to the next seminar. Sorry about that. You'll have to save your questions for office hours, I guess.
We'll hang out too. Oh, and I didn't put it up, but real quick, there's our contact information if you want to send us send us anything. You're welcome to do that. Thank you so much. Thank you for Startup Week for the opportunity and my co-panelists here.
Thanks, everyone.
Thanks.